There are 5 key factors that impact a stock's price, and I'll talk about each one of them in this video. Come check it out. Hi, I'm Lachlan Campbell, the founder of Mad Success. Our focus as a company is personal and financial well-being. Financial stress is now the #1 cause of mental health issues globally, including chronic stress, anxiety, and depression. And a big part of financial stress is a lack of financial knowledge, which is why we provide these free videos. For companies, we provide employee financial wellness programs, and for individuals, we provide personal development and financial education through one-on-one and group coaching and training and online courses. Please check out our videos at the Mad Success channel on YouTube, or follow us on Instagram and Facebook and learn more at our website, madsuccess.com. So, why do stocks move? It's a great question, because often when individual stocks or even when the market moves, we don't really understand why. But there are 5 primary reasons why stocks move. 1 is individual news of the founder or a C-suite executive, company performance and news, sector, industry performance and news, political, economic news, and the last one is the financial markets themselves. Before I jump into each, let me explain briefly about the value of a stock today and how we as investors should look at investing in stocks and the stock market in general. In theory, the value of a stock should today represent the present value of a company's future earnings. So if company performance, its sector or industry, or the overall economic climate are positive, then the share price of that company in general should be going up. The opposite is also true. If company performance is expected to deteriorate, or the sector is being hit hard, for example, by regulation or supply problems or lack of demand, then the share price should be expected to fall. As long-term investors, we don't want to be reacting and investing based on today's headline news. We want to be considering where the company, its industry, and the economy overall will be over the next 2 to 3 years and beyond, because in general, that is what is going to drive the share price higher or lower. It's easy to get caught up in the volatility of markets on any given day or over a short period of time. We get emotional and react, as many investors have done over the past 6 months. But the key to investing, not trading and speculating, but real investing, is to imagine what the world could be like over the next 2 to 3 years and invest in the best companies and in the industries that are going to pick up and thrive over that time frame, as those are the companies whose prices are going to rise. But if you don't read industry or economic research regularly and widely, then investing in individual companies or even in specific sector or industry ETFs is quite risky. You're putting your financial future at risk. And this is why people like me with 30 years of investing experience recommend index funds for new and non-professional investors as the safest way to invest for the long term. So let's talk about the 5 primary reasons stock prices move. Let's start with the impact of key individuals. Consider these names and what comes to mind when you think of them. Steve Jobs, Mark Zuckerberg, Warren Buffett, Elon Musk, Jeff Bezos, Bill Gates. In January 2011, when Steve Jobs announced he would take indefinite medical leave from Apple, the share price of Apple fell that day by 9% in Europe and a further 6% in the US when markets opened. But his health had been a question since 2004, when he was first diagnosed with pancreatic cancer. Yet in the 2 years from 2009 to 2011, prior to the announcement of his indefinite medical leave, the share price of Apple had quadrupled because of the performance of the company and with him at the helm. When Steve eventually passed away, the share price dipped, but it subsequently surged again under the long-time stewardship of Tim Cook. And look more recently at news from Elon Musk. You know, when he tweets, the share prices of Tesla and Twitter can move up and down substantially depending on how the market perceives his statements or his actions. The market value of certain companies, like the ones I've mentioned, can depend strongly on the presence of certain founders and/or CEOs or other key C-suite executives. So they represent a potentially critical element for the success or failure of the company and their ability to generate future revenues. The opposite can also be true. The departure of certain key personnel in the company could be very favorable if they created a toxic corporate culture, for example, or managed the company inefficiently. And a well-known and well-respected replacement CEO could have a substantially positive impact on the value of the company's shares. Which brings us to the second point, the performance of and the news of a company. As I mentioned earlier, the share price represents the present value of future expected earnings of the company. If the expectations are that the company is going to underperform its competitors, for example, the share price could fall or just not rise as quickly as competitors in a good market. If the performance of the company is expected to be excellent, the share price could rise substantially. But there are many factors that impact companies, including from the founder and CEO, the cost of their input prices, such as we're experiencing now with global rising inflation. Companies are impacted also by inflation through the cost of the people they hire, when wage prices rise, and the cost of goods and services they use to create their own goods and services that they sell. If their costs rise faster than their sales and they generate less profit, the share price will fall. If their costs fall while sales remain the same or grow, the share price could rise, as expected future profits are rising, and that is share price positive. But companies are generally impacted by the performance and expectations and news of their industry, which is factor 3. If the industry is expected to outperform in the coming years, the share price should also outperform unless the individual company itself is underperforming. If the industry is expected to run into troubles, such as we're seeing in the auto sector right now, not being able to get a hold of enough microchips for their automobile operating systems, and a shortage of other component parts, then the industry will underperform and each company can be expected to underperform. Unless a company had maintained higher levels of component part inventory, for example, and can keep producing their vehicles, then this company's share price should outperform the other companies in the sector. The political economic climate, point 4, can also dramatically impact an industry and individual companies and their share prices. If the government decided to impose a harsh tax on an industry, that could have severe impact on profitability and share prices could fall. The opposite also being true. If there was a war, such as in the Ukraine, share prices would fall of the domestic economy and any countries around the region that are also being impacted. We're going through a global economic downturn right now and recession, and most share prices are falling as company costs rise along with rising interest rates and inflation. Profitability at companies around the world is expected to be less next year in 2023 as a major recession is potentially looming. But what will happen after the next 18 to 24 months? Which industries will thrive in recession and come out of it first? These are the industries and related companies whose share price could rise first fastest. Industries where consumers will continue to purchase, such as utilities, electrics, oil and gas, water supplies, or what are called consumer staples. These are the goods like toothpaste that you're going to continue to buy no matter what happens with the economy. These are the types of industries to watch, and there are others. Some forms of insurance may also have to continue. Others will become a question mark around what is needed or not needed. But if you do not spend a regular and consistent amount of time analyzing specific industries, and you do not analyze specific companies in depth, this is why I recommend investing in exchange-traded index funds. You can diversify your risk and own the largest companies of the stock exchange as you learn and grow your knowledge as an investor. Politics impacts share prices because unstable governments can impact industries and companies. Stable governments usually mean stable economies and stable policies. Stability tends to be stock market positive. Instability tends to be stock negative because of the uncertainty that can impact the economy, industries, and companies. The fifth and final impact is in financial markets themselves. Hedge funds and other investment companies that trade using high-speed mathematical formulas called algorithms can trade in and out of stocks before you can blink. When professional investors believe a company or sector could start to have problems, this is usually long before it is evident to ordinary investors like you and me. So these professional investors will short the stock of the company, putting downward pressure on the prices, and you may not even understand why yet. In investment language, when you buy a stock, you are going long the stock. That just means you're an investor in the stock and you are betting that the stock price will rise. If it does, and you sell the stock in the future at a price higher than what you bought it for, you will make a profit. Shorting the market, going short, means you are betting that the stock price will fall. If it falls in price far enough, you can make a profit. The easiest way to short a stock is buying a put option, but this is not an options course. But know that shorting means profiting when the share price falls. Professional investors therefore can impact the rise or fall of a share price by the collective momentum of investor trading and the direction of their buying and selling. This is another reason for investing in stock indices, because it's nearly impossible to compete at the speed and with the knowledge level that professional investors have at hand. I know, I was a hedge fund investment analyst and investment manager for many years. I used to manage hundreds of millions of dollars in investments, and we have an advantage over the ordinary investor because we have real-time information. We're having conversations directly with the CEOs and founders of major companies. We often met directly with the heads of countries, the ministers of finance, etc. And we had direct information from them as to their policy initiatives and outlooks. The ordinary investor does not get that information until hours, if not days or weeks later, when the information is finally picked up by the media. This is also why I recommend you start reading economic and financial research published by companies like the Motley Fool or Maudlin Economics. They have free and paid services. I pay for research so that I can see the most current thoughts of the top economists and company analysts in the world and in the US. If you are serious about investing, it can be money well spent for high quality research. In summary, there are many factors that move stock prices, so it's important to either have an excellent research source for your higher level investing and thinking, or stick with broad market index funds for diversification and to spread out your risk. On a last note, start learning about bonds, because interest rates are going to continue to rise and the yields on bond funds are becoming competitive again with stock dividend funds and those of real estate investment funds. Happy investing! And if you received value from this video, please like the video and subscribe to the Mad Success channel on YouTube. I'm Lachlan Campbell. Cheers.